Chinese retail sales rose more than expected in the past month. A National Bureau of Statistics spokesperson attributed the spike to stimulus like the Consumer Goods Trade-in program and the upcoming 618 shopping festival. But challenges to the Chinese economy, including persistent inflation and trade uncertainty, that, still persists. With industrial growth slowing from April. For a read on what this means for international investors, I want to bring in Jay Pelosky, who is the TPW Advisory founder. Good to have you here back with us. Just take us into your read-in on some of the data that's come out from China on the consumer right now and some of the retail spending that we were seeing.
Well, Brad, I think it's pretty clear that China understands its export dependency on the U.S. consumer is kind of a strategic risk. And so they're trying to offset that and hedge that by stimulating their own consumer, who, really has been in the doldrums since COVID, right? So if you look at the U.S. consumer the last couple of years, record high stock prices, record high house prices, compare that to the Chinese consumer, where real estate has been in the doldrums for 3 or 4 years. Stock prices have been weak for the last couple of years. So consumer confidence in China has been flat on its back. And really, that's the effort that the government is trying to stimulate using fiscal stimulus, which China has plenty of space for, very importantly, as does Europe, plenty of space to use fiscal stimulus to try and support consumption, particularly around big ticket items. So I think of, washing machines, dishwashers, refrigerators, things of that nature.
Jay, I've been trying to read through some of the IDC data that is really tracking across the smartphone market, especially to see how U.S. companies are holding up in China, especially knowing that the U.S.-China tensions have fueled some unsettling news for those U.S.-based companies. And it kind of triggered the question as we were reading through this data in our morning meeting, trying to figure out the biggest winners and losers of a spending consumer in China.
Well, the biggest loser is Apple. Right. I mean, clearly, the U.S. has made it clear to China that it's walling off the U.S. Tech space. China is now doing the same to U.S. companies. So you look at Apple. I mean, it's as simple as just punching up the Apple chart. One of the worst performers in the tech sector in the U.S. because it's dependent on Chinese consumption. And Apple is plummeting down the ranks of best-selling smartphones in China, with Huawei, the domestic producer, dominating the space. You see the same thing in EVs, right? Where Tesla a couple years ago was a market leader in China in the EV space. Now it's barely top 10 as BYD and Geely and others dominate the space. So, China is a very successful practitioner of industrial policy. And they have mastered that through the drive to conquer the renewable space, which they now do. They control and dominate the entire renewable energy space. They're now pushing that into robotics and advanced manufacturing and tying that into AI to become, a really important player globally. And so it's one of the markets we're most keen on. We're overweight Chinese equity using U.S. listed ETFs, which is what we focus on. And we have been overweight Chinese equity for over a year, and we expect it to continue to do well. We like emerging markets more broadly. We think the setup there is extremely attractive, and we're quite constructive on what we call the global growth long cycle that we think will extend through 2027, 2028, and perhaps into the end of the decade.
I wonder how and after we come off last week, which was a week of some of the treasury auctions that were taking place, I wonder how you're reading through some of the international purchasing that's happening and ultimately the demand appetite for international investors investing in U.S. bonds and then vice versa as well, where you hear about some of the U.S. firms that are trying to make sure that they have international exposure right now.
Yeah, no, these are the key questions, Brad. If you're a global macro investor, as we are at TPW Advisory, this is really the heart of the matter. And last week was a great tell, right? When you have a surprise hit the markets, as we did on Friday, to watch how the big cross assets, stocks, bonds, currencies, how they react is really telling. And last Friday was extremely telling, right? You look at the dollar, no reaction, right? The dollar was actually down last week. It's at a 3-year low, so no bounce whatsoever on any kind of safe haven. More importantly, to your point and your question, look at the Treasury market. No rally in Treasuries last week, last Friday, or over the weekend. So that is telling you as clear as day that domestic and foreign investors have no appetite for adding significantly to their Treasury positions, to their dollar positions, or to their U.S. equity positions. The U.S. has been the place to be for the last 15 years. It's priced at a premium. You have massive governance questions around the Trump administration, massive questions around taxation, tariffs, you name it. How does that fit with a premium valuation? The answer, it doesn't. And so the opportunity set has migrated. We believe we're at the beginning of a secular leadership change in global equities away from the United States to the rest of the world, fueled and supported by what we think will be years of capital repatriation out of the United States, back to Europe, back to Asia, back to emerging markets, as countries recognize they need to fund their own efforts in AI, in climate, and in defense.
And so, Jay, as we were talking about earlier on in the hour, there is now more modeling around what the long-run tariff rates expectations are from major institutions. What are you modeling for? What are you anticipating?
Well, we're not really big on models here at TPW Advisory, Brad, to be honest with you. We're kind of a little bit more old school, but we expect that, look, the bottom line is the U.S. has a government that is a uncertainty factor that continues to press on the uncertainty edge, right? We're now talking about another Liberation Day where the president's going to simply put his number on a piece of paper and send it to people. So look, that's just not how folks want to play the game. And so the rest of the world is going to work around the United States as opposed to being part of the United States. And if we end up with an administration that is in power for the next several years, we believe that at the end of this decade, the gap between where the U.S. is as a competitive global economic power versus Europe and versus Asia, and particularly China, is increasingly wide and not in favor of the United States because the U.S. is going backwards on EVs, backwards on industrial policy, whereas Europe is stimulating, using its fiscal stimulus, recognizing it has to spend in its own defense, building out its AI capacity. And China is doing the same and is basically sewing up Asia.
Yeah.
The president of China is going around to Malaysia, Cambodia, et cetera, saying, we want to do business with you.
Right.
The United States is adding 45% tariffs on them. Which would you choose?
Jay, all great points. Good to have this conversation with you. Would love to keep it going. Got to have you back.
Thank you, Brad.
Thank you.